If you're staring at your charts right now thinking, I need another indicator, this video might actually save you years. Because here's the crazy part. I don't use RSI, I don't use MACD, and I don't use Bollinger Bands. In fact, I only use 3 indicators and none of them tell me when to buy or sell, and yet they completely changed how I see the market. Most traders lose not because they're bad, but because they're overloaded. Too many signals, too much noise, no real understanding of why price moves. If that's ever been you, staring at a perfect setup that still loses, you're not alone. I've been there. What I'm about to show you isn't a strategy. It's not a secret indicator. It's a framework that tells you where liquidity is sitting, when the market actually wants to move, and why price reacts at certain levels again and again. Once you see this, you can't unsee it. So if you want cleaner charts, better timing, and trades that actually make sense, stay with me because these are the only 3 indicators I use to day trade and they changed everything. And quick question. How many indicators are on your chart right now? Be honest with me. RSI, MACD, moving averages, maybe even a stochastic, or maybe all of them. Now, here's what's wild. I make my trading decisions using 3 indicators only, and none of them tell me buy or sell. No arrows, no signals, no overbought, oversold nonsense. And once I stopped letting indicators tell me what to do, and started using them to understand where price is likely to move and when, everything changed. Now, just so we're clear, this isn't one of those videos where I say use these indicators and print money. I don't trade indicators, I trade price, time, and liquidity. The indicators I'm about to show you don't predict the market. They don't lag, and they definitely don't spoon feed entries. What they do is they help me see what most traders completely ignore: when the market is actually active, where money is likely sitting, and why price reacts at certain levels again and again. And once I simplified my charts down to this framework, trading stopped feeling random and started to make sense. Here's the uncomfortable truth most traders don't want to hear. Most indicators don't fail traders. Traders misunderstood what indicators actually are. Think about it like this: RSI, MACD, moving averages, they're all just maths applied to past price. They don't see orders, they don't see liquidity, they don't know why price moved, only that it already did, and that's the trap. Retail traders use indicators to ask, should I buy or sell? But the market doesn't care about your signal. It moves because large players need liquidity to enter and exit positions. Banks, funds, and algorithms, they're not waiting for RSI to hit 30. They're targeting areas where stops are sitting: highs, lows, ranges, clean price levels. That's why you'll see this happen all the time. RSI says oversold, you buy. Price drops a little more, grabs liquidity, then actually moves. The indicator wasn't wrong. You were just early, and early in trading feels exactly like being wrong. This is where frustration comes from. Traders stack more indicators hoping for confirmation, but all that does is give you late confirmation on a move that's already happened. So you hesitate, you miss the trade, or even worse, you chase it. The moment trading changed for me, it was when I stopped asking indicators what to do and started to use them to understand context. When the market actually is active, where liquidity is likely sitting, and at what prices does money naturally react. Once you answer those questions first, entries become a lot simpler because you're no longer trading blind. So let me simplify this for you before we go any further, because this is where most people overcomplicate things. The 3 indicators I use each have one job only. They don't overlap, they don't contradict each other, and they definitely don't fight for attention on my chart. The first indicator shows me when liquidity is likely being built. That's the market sessions indicator. The second one shows me where price naturally reacts. Those are the quarter levels. And the third indicator tells me when the market is most likely to actually move. And that's the 90-minute cycles. And that's it. One indicator for time, one indicator for price, and one indicator for structure. I'm not looking for signals. I'm not looking for confirmation. I'm building context. So when price does something, I already understand why. And as I go through each one, I want you to notice something very important. None of these indicators tell me to click buy or sell. They help me eliminate bad trades, stop over trading, and only focus on moments where the market actually makes sense to trade. Once you see how these fit together, you will realize you don't need more tools, you need clearer ones. The first indicator I use is market sessions, and honestly, this one alone already puts you ahead of most traders. All it does is mark out the Asian, London, and New York sessions on your chart. Simple but powerful. Most traders treat the market like it moves the same way all day, same strategies, same expectations, same behavior, and that's not how markets work. The market has rhythm, and that rhythm changes depending on who's active. For me, the most important session here is Asia, not because I trade it, but because I study it. Asia is typically slower, lower volume, less aggression, and a lot of the time price just moves sideways, consolidating. Now, here's where it gets interesting. When price consolidates, it creates similar equal highs and similar equal lows. That's where stops build up. Above the range, you've got buy stops, and below the range, you've got sell stops. That range becomes a liquidity pool, whether traders realize it or not. So when London opens, when real volume comes in, price usually doesn't move randomly. It goes looking for something, and very often that something is the high or low of the Asian range. So my job during Asia is simple. I mark the high of Asia, I mark the low of Asia. I don't trade it, I don't guess direction, I just wait. This alone removes so much noise. Instead of chasing candles, I already know where liquidity is likely sitting before the sessions even start. So when price runs above Asia or it sweeps below it, I'm not surprised, I'm prepared. So let me just quickly show you the trading view indicator that I have here on my chart. So if you head over to indicators, you'd want to search for FX market sessions by the author Boy Toki. And these are the settings which I have. So these will be different to the default settings which are on this indicator itself. So I've put my time zone to GMT -5. So that matches with the New York time zone. So for Asia at GMT -5, I've got it 7 p.m. to midnight. Then for London, I've got it midnight to 6 a.m. And then for New York, I have it 6 a.m. to 12 o'clock. So of course, change this as per your time zone on your indicator and on your charts. And let me show you a quick example. So you'll see exactly what I was just talking about just now. So this is price action from today. So it's the 30th of December 2025. So you've got a Asian range, which is a tight consolidated range. When the London trading session opened, price traded above this range before making the real move for the day in the New York trading session to the downside, trading below the Asian trading range. So price took out buy stop, so buy side liquidity above the Asian trading range before trading below it and closing in at a bearish day. And now if we look at, say, yesterday, again, Asian range was a tight sideways range. During London, price traded below it. And then in New York, price eventually then traded above the Asian range and then taken liquidity. And then let's just look at a third and final example. So the day before that one, you've got your Asian range, London trading session traded below the range, and the New York volume came in trading above the Asian range. So London took out the liquidity below the range, and the New York came in with its volume taking out liquidity above the Asian range. So if you now, of course, use this indicator on your charts and then pair it up with whatever trading strategy that you use, whether it's SMC, and supply and demand, this adds a further level of clarity to whatever trading strategy you use. So now here's the key thing. Market sessions tell me where price might go, but not where it should react. That's where the second indicator comes in. And this one explains why price respects certain levels again and again. The second indicator I use plots quarter levels, which is basically a horizontal line every 25 pips, as you can see here on my chart. And at first, I'll be honest, this one sounds almost too simple. Most traders hear this and think there's no way price respects something that basic. But once you understand why these levels matter, you start seeing them everywhere. Markets are driven by orders, not indicators. And orders tend to cluster around clean, logical price levels. Institutions don't scale positions at random numbers like 1.27463. They work around round numbers and structured increments, such as at every 100 pips, 25 pips, 50 pips, and 75 pips. This isn't just a retail thing either. Humans naturally think in chunks, and algorithms are programmed to execute in brackets. So what happens? Liquidity builds around these quarter levels and price reacts. You'll see price approach a 25 pip level, slow down, consolidate, fake break, or reverse completely. And once you notice it, you can't unsee it. Now, I don't treat quarter levels as automatic buy or sell zones. I treat them as areas of interest. If price is running into a quarter level during London, after taking Asia liquidity inside a strong time window, that's when I pay attention. But what I don't do is trade every touch. Quarter levels don't mean enter here. They mean something might happen here, and my job is to wait for the market to show its hand. This alone removes so much FOMO. Instead of chasing price in the middle of nowhere, I'm patient, I know where reactions are likely, and I let price come to me. So let me show you the indicator on TradingView again. So the indicator which I use to plot these horizontal 25 pip lines is quarter theory and whole numbers by the author Rain 5369, and here are my settings. So you don't really need to do anything here. All I've changed are, of course, the colors for aesthetic purposes, but you can pause the video here if you want to copy my settings as well. But I mean, of course, just tailor it to your charts as you wish. So with this example here, so we've got the Asian, well, we've got the market sessions indicators already on, and now we've got the quarter levels indicator on. So you've got the Asian trading range. During London, price traded towards the upside, taking out liquidity, which is resting above the Asian range, and it went precisely to the quarter level of 1.3525, as you can see here. And then from this quarter price level, price reacted. So I can already see you could have entered with this retracement back into it, and I'm sure you've got further confirmations if you go to different time frames. But my point is that price came to this quarter level and then reacted from here precisely to the downside. And as you can see, when price comes to a quarter level, so with this example, price at 1.35, you can see how price comes and then it just bounces at this price level before going to the next quarter level. And at every quarter level, well, once you have this indicator plotted on your chart, you will notice that there's a common theme that at every 25 pip price range, it acts as a invisible supply and demand area. And again, this just adds another layer of clarity to your chart, and you know roughly at what price levels you can expect price to react from. So now we've got two things covered. Market sessions, they show me where liquidity is sitting, and quarter levels, they show me where price is likely to react. But there's still one missing piece: when the market actually wants to move, and that's exactly what the third indicator solves. Alright, the third indicator is the one that stopped me from overtrading. It's called 90-minute cycles, and what it does is it will split London and New York into 4 equal 90-minute blocks. So as you can see on my chart, so I have this indicator enabled and it will split both the London and the New York trading sessions into 4 equal 90-minute trading blocks. Now, that sounds simple, but the reason it matters is huge. Most traders think the market is just candles printing all day long like it's one continuous flow. But in reality, price moves in phases. You'll have periods where nothing happens, then suddenly it runs stops. Then it trends hard. That's not random, that's a process. This is where the AMD model also comes in, which is accumulation, manipulation, and distribution. And no, you don't need to make this complicated. You've literally seen it thousands of times, but you just didn't label it. Phase 1 is accumulation, where price goes quiet, it ranges, it compresses, it looks boring. This is where most traders get impatient and start forcing trades because they feel like they need to be doing something. Phase 2 is manipulation. This is the classic stop hunt, that sudden spike above a high or dump below a low that triggers breakout traders. Hit stops, creates panic. And here's the key: that move is often designed to grab initial liquidity, not to start the real trend. Then comes phase number 3, which is distribution. This is the real move, the clean push, the trend that actually delivers. And once you understand this, you stop trying to trade every candle and you start waiting for the phase that pays. So why the 90-minute cycles? Because these phases tend to show up inside specific time windows, especially in London and New York when volume is high. The indicator basically keeps me disciplined. It tells me this is a window where accumulation is likely, this is a window where manipulation often happens, and this is where distribution tends to deliver. So what I'll do is this: I already have my Asia range marked from indicator number 1. I already have my quarter levels on the chart from indicator number 2. Now I use the 90-minute cycles to time it. If we're in a fresh London block and price starts sweeping Asian highs and lows and we're reacting at a quarter level, I'm not guessing anymore. I know what phase we're likely in, and that tells me whether I should be patient, cautious, or ready. This indicator protects me from the biggest killer in day trading: random entries in random time, because a good setup at the wrong time can still fail. But when time, liquidity, and price line up together, that's when the market starts to feel predictable. So let me show you the indicator. So again, just go to indicators, and the one which I use is this very first one called Day at Joshu by the author Joshu. So if you add this on, you shouldn't need to change anything, as these are the default settings which it adds onto your charts. And let me show you an example here. So we've got a tight sideways Asian range, and then During the London trading session, we traded below it, but in quarter one, it was accumulation where price just stayed sideways. Quarter three, it was the same. It was just accumulation where price just stayed sideways. And then in quarter three, so the third 90-minute trading cycle of London, price traded below the Asian range. So we can say this is phase two, which is manipulation. So price has now manipulated to the downside. So now we can expect at some point in the day, price is to be bullish to trade above the Asian range now. So this is now manipulated. This is not the real move for the day. We're not bearish. We should be actually expecting a bullish move. This is just the manipulation. So again, during London, there wasn't really an entry here for this specific day. And then Q4, we came back into an accumulation phase. But however, after accumulation, so again, as I already spoke about this, which is phase one, the next phase, again in here, which was Q1 of New York, that was our manipulation phase. As you can see, there was a spike below this accumulation in Q1 of New York, which again, that was the grab of liquidity. And this was also precisely at the quarter level, which is shown by this horizontal line at 1.335. So once the liquidity was taken, price began to trade towards the upside above the Asian trading range. And just by looking at this, you'll notice that each 90-minute trading cycle, it has its own characteristic. So as you can see in Q2, it was bullish. Then as soon as Q3 began, price became bearish. And then as soon as the last 90-minute cycle began for the day, price kind of stayed sideways and volume just slowed down. So again, this just helps with knowing when to trade, when to exit out of trades, and when to start taking profit. So now you can see the full picture, where market sessions show me where liquidity is likely sitting, quarter levels show me where price tends to react, and the 90-minute cycles, that shows me when the move is most likely to happen. And in the next part, I'm going to show you exactly how I combine all three into one simple process, so you can literally repeat it every day without staring at the charts for 12 hours. In this part, guys, please just listen and make notes. It is very key. So I'm just going to show you how this all connects, because this is the part that makes it powerful. On their own, these indicators are good, but together they give me a simple routine which I repeat every single day. So step one, you want to start with the sessions, which builds the map. So the first thing that I do is I look at the market sessions. I'm not trying to predict direction. I'm just asking one question. Did Asia consolidate? Because if Asia is tight and range bound, it creates a clean pool of liquidity on both sides of the market, the high and the low. For example, Asia basically, say it goes sideways for hours. That's not nothing happening. That's liquidity building. And then step two is where I now mark the targets. So the Asia high and the Asia low. So I will mark out the Asian high and the Asian low. Those become my targets, not my entries. I'm not saying price will definitely sweep them. I'm saying if the market wants liquidity at London Open, these are the obvious places to grab it. For example, say if London needs fuel to move, where's the easiest fuel? Right above that clean range and right below it. Now step number three is to add the quarter levels, which are your say invisible supply and demand area. So every 25 pips. This is what stops me from trading in the middle of nowhere, because when price approaches a key liquidity and it's also aligning with a quarter level, the chances of a reaction increase massively. For example, say you have Asia lows and it lines up near a 25 pip price level. That's not coincidence. That's a clean area where orders tend to stack. Now, step number 4. You want to wait for the correct time window. So the third piece is timing the 90-minute cycles. This is how I stop forcing trades, because even if you have a clean level and even if liquidity is sitting there, it still matters when you're trading it. For example, a perfect setup at the wrong time is still a bad trade. This indicator keeps me inside the windows where moves actually deliver. Now, step number 5, the 3 filter checklist. Simple and repeatable. So here's my routine. I literally think of it like 3 filters. Filter number 1, are we in the right session, London or New York? Filter number 2, did price grab liquidity, such as sweeping Asian highs or lows? And filter number 3, are we at a meaningful price area, so a quarter level? And if those line up inside a strong 90-minute window, now I'm locked in. For example, if all 3 aren't there, I don't care how nice it looks, I'm not trading it. So let me give you a typical day. Asia ranges, London opens, price pops up, takes the Asian high. Everyone thinks it's a breakout, but then price taps a quarter level inside a fresh 90-minute block. And that's where the reversal or the real move can begin. That's not me guessing, that's me watching the market do what it always does. Build liquidity, take liquidity, and then move. And this is why I love this framework. It doesn't make me trade more. It makes me trade less, but better, because I'm not reacting to candles. I'm waiting for the market to show me, yep, the liquidity is taken. We're at a key level and timing is right. Now, the reason this works so well is because it's not a signal system, it's a context system. And in the next part, I'm going to tell you what I don't use, because once you see this, you will realize most indicators, they're just distracting you from the real game. Now, this is the part where a lot of people expect me to start adding more tools, but I'm actually going to do the opposite. I want to show you what I don't use, because this is just as important. I don't use RSI, I don't use MACD, I don't use stochastics, I don't stack moving averages on my chart. Not because they're bad, but because they don't fit how I trade. Most indicators are designed to answer one question: is price overbought or oversold? But the market doesn't reverse because something is overbought, it reverses because liquidity is taken, orders are filled, and time aligns. When you layer indicator on top of indicator, all you're really doing is delaying your decision. By the time everything lines up, the move has already happened. I used to think more confirmation meant more confidence. In reality, it just made me hesitate. My chart was full, but my understanding was empty. Now my chart looks boring to most people, but that's intentional, because if my chart is cluttered, I know my thinking is cluttered too. I'd rather understand why price is at a level than argue with 3 indicators that all disagree. Most traders are looking for signals, I'm looking for conditions. And once the conditions are there, entries become simple, if not sometimes obvious. And this is why this framework isn't for everyone. In the next part, I'm going to tell you exactly who this approach is for and who it's not for, because that matters more than people realize. Now, I want to be real with you. This approach isn't for everybody. And I'm not saying that to sound exclusive. I'm saying it because if you try to force this into the wrong style of trading, you'll miss the point. This is for you if you're the type of trader who wants clarity. You don't want 20 indicators fighting each other. You don't want to be glued to the chart all day. You want to know, when is the market active, where is liquidity likely sitting, and what price matters the most. If you're a day trader, session trader, or someone who trades London and New York, this will fit you perfectly. It's also for you if you've ever taken a perfect setup and it still failed, and you sat there thinking, how is this even possible? A lot of the time it's because you were trading without context. Either it's wrong time, wrong area, wrong reason. This framework fixes that, but if you're looking for an indicator that gives you a green arrow and says buy now, this isn't that. If you want to scalp randomly throughout the whole day, clicking trades every 5 minutes, this probably isn't the best fit either, because this style of trading requires one thing, which is patience. You're waiting for the market to come into your price zones, not chasing it when you're bored. You're trading quality windows, not forcing quantity trades. This isn't a more trade system, it's a better trades system. The goal isn't to feel busy, the goal is to be right more often and only show up when the market is actually set to move. And if that sounds like the kind of trader you want to become, perfect, because the biggest takeaway from this entire video is this. These indicators, they're not here to predict price, they're here to help you understand time, price, and liquidity. And once you see the market like that, you can't unsee it. So here's the real takeaway from all of this, and I want you to really hear this. The goal was never to find the perfect indicator, the goal was to stop trading blindly. Indicators don't make money, understanding time, price, and liquidity does. The 3 indicators I use don't predict the market, they don't tell me what will happen, they help me understand what makes sense in the moment. Most traders react, they see a candle move and think, I need to be in this. I do the opposite. I already know where liquidity is likely sitting, I already know what prices matter, and I already know when the market is most active. So when price moves, I'm not surprised, I'm prepared. And once you simplify trading like this, something interesting happens. You trade less, but with more confidence. You stop second guessing every candle. You stop needing constant confirmation because you finally understand why price is where it is. This is the difference between someone who uses indicators and someone who actually reads the market. One is hoping, the other is waiting with intention. So remember this framework. Sessions show you where liquidity is built. Quarter levels, they show you where reaction happens. 90-minute cycles show you when moves are likely to deliver. That's not complexity, that's clarity. Trading doesn't get easier because you add more tools. It gets easier when you finally understand what actually moves price. If this video helped simplify things for you, do me a favor then, hit the like button, not for the algorithm, but so I know this kind of content is actually helping real traders. And I'm generally curious, which of these 3 indicators clicked for you the most? Drop it in the comments. I read them and it helps me decide what to break down next. If you want more videos like this where trading actually makes sense, instead of feeling overwhelming, consider subscribing. Everything on this channel is about clarity, patience, and trading with intention, not hype. Thank you for spending your time with me. Stay patient, stay disciplined, and I'll see you in the next one.